Shares of General Motors are trading for an incredible valuation right now, just over 4 times forward price to earnings multiple. That is a crazy cheap. That is a crazy cheap stock, especially for a company that continues to grow, that gained market share in 2024. Revenue grew almost double digits. So this is a very high performing company at the moment, generating a lot of free cash flow, and management just announced another massive buyback program that will buy back over 10% of the company's shares outstanding. That's a big reason why I think this company can outperform the market. But I want to go through the numbers and why I think investors are underestimating the potential of GM today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the company's revenue and cash flow trends. And this is in light blue. These are on different axes. So that's why the numbers are very different. But $187.44 billion worth of revenue in the past year. Just for context, that was up 9.1% from a year ago. So while you're seeing some companies decline, General Motors is actually increasing their sales. I'll get to where their trends are actually moving in the right direction. Trucks and SUVs, no surprise here, are going to be the big story for them. But the other thing here is that free cash flow, $9.3 billion. Now, keep in mind, General Motors today, as I'm recording, has a $48 billion market cap. So that means that their free cash flow is less than 5 times their current market cap. And they actually have a net cash balance on the balance sheet. I'll get to that balance sheet too in just a minute. But this is a much better positioned company than you might think. So where's the company doing well? This is a big piece of the story. Full size trucks and SUVs. And the key here is full size, because this is going to be much higher price points than a lot of the smaller competitors. So here, what you have pictured is the Tahoe in the bottom left, the Escalade in the bottom right, and the GMC Yukon in the top right. And they showed here the incentives per vehicle as a percentage of average transaction price. You can see that GM is giving less incentives than most of their competitors. This is something you see if you just go look for a new vehicle right now. GM is not giving in on price, where you can walk into a Volkswagen dealership or even a Ford dealership and you can get a pretty good chunk off of the listed price. They also have some interesting smaller SUVs. Again, these are not going to be quite as profitable, but their average transaction price is actually 15% higher than their outgoing models. So these have been extremely popular, very high growth in some of these Trax and Equinox sized vehicles. And let's not forget the growth that we've seen at GM in electric vehicles. Now 12.5% market share. Chance that this could be the #1 selling electric vehicle company in the US by the end of 2025, depending on how Tesla does. But they're #2 right now. If Tesla continues to decline, like we've seen over the past just few months, even the past year with Tesla, their sales were down in the US. GM was taking share, and now their unit sales were 44,000 in the fourth quarter alone. That should increase as we see more electric vehicles hit the market. So operationally, things are going really well for General Motors. Obviously, you have the economic backdrop. If we go into a recession, if interest rates go up, there's going to be macroeconomic concerns that GM is just not going to be able to control. And that's one of the reasons that auto manufacturers typically trade for a relatively low multiple, because those big things can actually put a company out of business really quickly. So those big risks can be a massive impact to the company's income statement or balance sheet. But let's go to that balance sheet, because this is one of the things that I think is often really misunderstood by investors. You see things like GM has a ton of debt, has over $100 billion worth of debt. How could you value this company so highly? Look at the debt that they have on the balance sheet. It's broken into 2 things. So you see short-term debt, and this is also the current portion of long-term debt, and it's broken into automotive and GM Financial. The automotive debt, this is short-term alone, $2.1 billion, GM Financial $37.3 billion. That's a big number, but that's going to be similar to a bank having debt or using customer deposits to put out loans to customers. This is going to be the money that customers are using when you go to GM and you get financing for a vehicle. That's going to come from a place like GM Financial. So that's 37.3. That's the short-term number. Long-term, this is the automotive piece, $13.3 billion in debt. GM Financial is 76.9, basically $77 billion worth of debt. So GM Financial has over $100 billion worth of debt, but GM, the auto company, only has about $15.4 billion worth of debt. $15.4 billion, not a small number, but now look at the cash that's on the balance sheet. $20 billion of cash and cash equivalents, and another $7.3 billion worth of marketable debt securities. So in total, GM Auto has a net cash balance. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. That's why you get moves like this. This is from February 26th. GM announced another buyback. They bought back over $10 billion worth of stock between November 2023 and the end of last year. So they announced a new $6 billion share repurchase authorization and an accelerated share repurchase program of $2 billion. On top of that, they're going to have plenty of cash to invest in the business, $10 to $11 billion worth of capital expenditures and R&D and product development of another $8 billion. So this is a business that continues to generate cash year after year after year. They're gaining share in electric vehicles. They're doing really, really well in trucks and SUVs. Yes, there's of course the risk of an economic downturn that could hurt their sales, could hurt their margins, but there's a huge cushion between where they are today and where they could potentially be if volumes decline or even if pricing declines. I think GM is in a phenomenal position. They have a net cash position in that auto business. And management is able to use the excess cash that they have on hand to just simply buy back stock at a price to earnings multiple of about 4. This buyback strategy is something that GM has been executing for a couple of years now, since November 2023. That's when they really started aggressively buying back stock, and you can see the pace has accelerated. This chart doesn't even do those buybacks justice. On January 16th, 2025, shares outstanding were just 995 million. So that's going to go down even more with this newest buyback. Everything that management has done over the past few years has been about making the company more efficient and moving into vehicles that are able to have higher price points and higher margins. That execution is going extremely well, and there's potential tailwinds in the future from all kinds of services like autonomy, which could potentially add even more incremental revenue from SaaS services. So that's another thing that I think investors aren't really thinking about, is how this could be a company with more recurring revenue in the future too. But just the valuation alone and the solid footing that GM is on, I think makes this a phenomenal buy for investors at this price. You're not going to see a lot of stocks. You're not going to see a lot of stocks with a 4 price to earnings multiple, but that's what you get from GM today. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.